Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going back to the basics. We're going over something that I think a lot of people need to see if they're just getting started in the stock market or they're interested in getting started in the stock market, and that's how to invest in the stock markets for beginners, and this is updated for 2021. It is now January at the beginning of the year, so I just want to go over the basics if you're brand new to the channel, and I have some of the basic steps that you need to follow to get started if you're a new investor and have never invested before, if you're brand new here in 2021. And I broke it down into your top 5 steps. So if you follow these top 5 steps, then you'll probably be very successful in the stock market. And as you invest in these stocks, there's a lot you need to learn, but I wanted to break it down to the main bullet points that you need to learn in the course of this video. But if you're new to the channel, if you're not familiar with me, my name is Jordan. I'm the Millennial Investor. I invest into dividend stocks through these 4 charts right here. I list all the 24 companies that I own on this left column right here in tab A. And then on these top 2 charts right here, I track my annual and monthly dividend income. These are updated monthly, and these will be updated in about a week or so. And then I also track my portfolio value and my monthly YouTube income. So these are updated once again every single month. And these are my investing goals for 2021. Now, in my opinion, I think that there is a lot to go along with getting started with stock market investing. And one of those is your brokerage, which I'll go with that in a minute. But this is the platform that you use to actually buy the stocks that you're wanting to purchase. So if you click this, if you click Refer and Earn, this is the tab where I refer people to M1 Finance. So at the end of this video, if you're convinced, if you want to try this brokerage that I'm going to show, if you want to buy stocks with the same company that I buy stocks with, I would recommend you use this link that is down below in the description. I have referred 72 people and all of them have said that they love it. All 72 people that I've referred have gotten money for started. So right now, M1 Finance is having a promotion. If you get signed up and deposit $100 to the platform, you get $30 just for signing up. $30 for free in your brokerage, and that's part of the reason I have $60 cash in my portfolio right here. This $60, 2 of those came from 2 referrals, $60. So go ahead and sign up. It'd be really easy, and if you want to see my portfolio, I'll go ahead and show it in the video, but there's a link down below there in the description as well. And these are the 24 companies that I own if you want to pause the video. But let's go ahead and get started with step number 1. Step number 1 is to financially prepare yourself for investing, okay? And what this goes along with is getting yourself ready to invest. Because if you don't have money to invest, then you can't invest in the first place. It sounds pretty simple, right? And so some of the steps that I recommend to get started with that is to eliminate your consumer debt. If you have things like, for example, credit cards, or if you have things like, I don't know, auto loans, or whatever the case may be, if you have other forms of consumer debt, it's best to probably eliminate those first. And the reason that is because when you have consumer debt, a lot of times the interest rate is a lot higher than what you'll get out of the stock market. So your returns are actually better to pay off debt. And the other reason is that if you get a paycheck every month, you don't want to have that paycheck gone before you ever can even see any of that money to even invest. So if you have $1,000 a month, if that's what your income is, and you get $800 a month going out to payments, then you're not going to have a whole lot of leeway to invest or make any other type of financial decisions for your future. So in my opinion, eliminate consumer debt. And then step number 2 is to secure an emergency fund in cash. Now, it doesn't have to be physical cash. It can be a checking account. It can be a savings account. Now, I know in my portfolio, I only have $60 cash. I know what you're probably thinking. Wow, Jordan, you're not following what you preach. You only have $60 in cash. Well, I have a lot of cash on the side just in different accounts and checking accounts and savings accounts like Yada, which is also down below in the description, link in the description. But if you don't have an emergency fund, you'll probably not be a successful investor because you'll have to pull money out in case of emergencies, or you'll be a lot more volatile with your emotions because you won't have the type of financial hardening emotionally that we have when we have an emergency fund. So if you don't have that in place, it'll be a lot harder for you to invest. Next up, we have make a proper budget. If you don't have a budget set in place, if you don't even know what you have coming in and what you have coming out, which goes right back into step number 1, eliminate your consumer debt. If you don't know what comes in and what comes out, or what you even have left at the end of the month, you can't invest. Because if you make 10 grand a month and you have no idea what you spend a month, then you can't invest. Because, okay, what if we want to invest 5 of that, but your mortgage payment, your food, your bills, your utilities, all that add up to $6,000 a month? Then you're going to be short at the end of the month. So if you don't have a budget, then you can't even get started with investing. So before you even look into the stock market or getting started, I recommend you do those 3 things and financially prepare yourself, emotionally and financially. Step number 2, and this is going to be the bulk of this video. This is going to be what is most difficult if you're a brand new investor, if you're a brand new person to the stock market. If you are learning the basics, there is a lot to learn. That is the one thing that is really hard about this. When you first get started, it is just like a shotgun approach. It's just so much information is coming to you at once. So I'm just going to go over some of the main bullet points, just answer them really quickly. So first of all, what is stock in a company? So let's go back to my portfolio here. Okay, I own 24 different companies. Now I'll go ahead and pick one that's very easy that a lot of people understand. Let's go ahead and just start with Pepsi. This is one that a lot of you have known and seen every single day as you've grown up from children now to adults. And if you see Pepsi, you probably don't even know all the brands that they own. They own lots of things like Pepsi, Gatorade, Cheetos, Doritos, Quaker Oats, Lay's, Funyuns, Propel, lots of other brands that you don't even know and think about every single day. Now, regardless of that, the reason why I bring up Pepsi is because it is an easy one to understand. And as I own this company, actually, let me go back. Let me go back to Pepsi right here. So every time I make a deposit, you see this target number 5% right here. So every time I make a deposit, I have 5% of my money roughly go towards this company. And right now I own a little over 3 shares, this highlighted number right here, and I own it at 135. So these 3 shares represent my ownership of the company. So right now I own a part of Pepsi. Right now, if you go into a 7-Eleven or an OnQ or whatever gas station you go to and you buy a Pepsi product, I make a small piece of the profits. I am entitled to a tiny percent of the company. Now, Pepsi is one of the largest companies on earth, so obviously the amount that I own is a microscopic percentage. But still, Pepsi's performance affects my financial situation. So if Pepsi just goes to the floor, all their products fail, the management team does horrible, and this company does not thrive over the next decade, then I am financially hurt from that. My value of my investment, my money in this company, becomes less and less valuable. And on the flip side, if this company does very good and it increases in value, then I have more money as an investor because my ownership in the company is worth more. And so that's what's cool about the stock market is that it doesn't matter how much money you have. So right now, Pepsi is trading at 139. It doesn't matter if you have $100 to your name or if you have $100 million to your name. Everybody buys Pepsi at the same price today. If we were to click the buy button, me and you, the exact same time today, doesn't matter who has more money, who has more knowledge, we're going to buy it for the exact same price. So no matter what, you are owning a piece of this company, and this is why it's incentivized that you hold stocks for the long term, because when you own pieces of these corporations, they become very valuable over time. Now, what are dividend payments? The same thing with Pepsi. I'll use that example. You see these letter D at the bottom here, 81 cents, 93 cents, 93, 96, $1.02, all these dividend payments. I receive dividend payments as I own these companies. I'm going to go ahead and go to my dividend activity here. So all 24 that I own, that is my strategy, is a dividend strategy. You see all these payments, how they really just add up over time. All of these are dividend payments from the companies that I own. Now, some of these you'll recognize, some of them you won't. Like, for example, Home Depot is probably a company that you all know and recognize. Home Depot will pay me a dividend every 3 months that I own it. And so my largest payers, like let's go and look at my largest one, WP Carey, which is increasing every single quarter, will pay me every 90 days that I own the company. WP Carey is a real estate company. So every 90 days that I owned it, it will give me about $9. Now I know what you're thinking, $9 is not a lot, but these increase as you own them. So I'll look at Realty Income. This is another real estate company I own, and these pay me every single month. So on May 15th, they paid me 60 cents. In June 15th, they paid me 70. July 15th, they paid me 71. In August 14th, they paid me 83. In September 15th, they paid me 95 cents. In October 15th, $1.42. November 13th, $1.90. December 15th, $2.09, and January 15th, $2.65. So this company pays me every 30 days that I own it. And this is why as an investor, I'm incentivized to hold on to the company. Because not only will they pay me 30 days, every 30 days that I own the company, but it also increases the payout from 60, 70, 71, 83, 95, $1.42, $1.90, 209, 265, and then in February 15th, it'll be even higher than that, probably somewhere closer to around $3. And I know $3 is not a lot now, but one day, years down the line, this will eventually start getting to $50, to $100, to $200 a month just to own the company, no matter what the success is. Now let's go and get to third tab here. What is an ETF, mutual fund, index fund? Now an ETF is a collaboration of investments. It's a lot of different things. So let's say, for example, the most common investment, which if you're new, this is what I would probably recommend getting started with investing, SPY. Now what this is the top 500 companies in the world. Now I want you to think of all the large companies out there, and I'll go ahead and start showing you them. All these companies that are in the United States, Apple, Microsoft, Amazon, Google, Tesla, Facebook, Visa, Johnson & Johnson, JP Morgan, Walmart, Nvidia, MasterCard. All of these companies are in the S&P 500. And when you own SPY, if you just buy this one stock, you are actually buying 500 stocks. Does that make sense? So you're actually buying 500 companies in one price. These are the value of those top 500 companies in the United States represented in one number, 383 right now. And this typically goes up in value over time as these companies become more valuable, more profitable, and that's what an ETF is. And a mutual fund is typically something that you don't find online. And a mutual fund is what's next. That's normally what goes with the next tab. What is different from this with my retirement, with my work, i.e. a 401k? That is usually what you see with mutual funds. It's very similar to an ETF, but it could own a number of things, including bonds, including stocks, cash reserves, lots of other things. It's very in-depth. Mutual funds is not something you're really probably going to mess with. Index funds usually goes hand in hand with an ETF. So an ETF, like I said, is a collaboration of investments. An index fund usually tracks an index. So this is an ETF and an index fund. It tracks the index of the S&P 500, the most popular investment. So if you own SPY and you were to hold it for 10 years, there's a 90-something% chance that you're going to be successful, that you're going to make money, and your investments are going to be worth more than what it was 10 years ago. Now, next up, we have how much money can I lose? How much money can I make? Well, if you're just buying shares in companies, let's go back to my portfolio. Like, let's look at a different one that you all probably know. Let's go ahead and look at something like McDonald's. So if I own McDonald's and I buy one share of a company, the most that I can lose is what I invest. So actually, let's just take a real world example. What's my value of my investment? Right now, the value of my investment in McDonald's is $359 almost. So $359 is what I own worth of the company McDonald's. I own $359 worth of McDonald's. But McDonald's, now this would never happen, but hypothetically speaking, if McDonald's were to go bankrupt overnight, once again, would never happen. I mean, the chance of that happening is pretty much zero. But let's say it did. My $389 or whatever it was, that $300 that I invested in McDonald's is now worth zero. I can never lose more than I invest. Now, realistically, your investment's going to zero if you're investing correctly, if you're investing intelligently. That's never going to happen. But if it were to happen, I can never lose more than what I invest. I can only lose what I throw into the stock market. But how much money I can make never ends. It is literally infinity. The amount of money that you can make in the stock market, there's no cap, there's no upside. Okay, so like let's say for example, McDonald's, hypothetically, also unrealistic. Let's say that they tripled their revenues and their profits next year. Let's say that they just tripled their number of stores, they tripled their average ticket sales, their profitability skyrocketed. All great things that could happen to McDonald's happened. Okay. And let's say the McDonald's went to $10,000 a share. All right, let's say it just skyrocketed. Then the value of my investment is far, far, far greater than what it was a year or two ago. So let's say, for example, right now I have $360 worth of McDonald's and the stock goes up times 10. Then I no longer have $360. I now have $3,600 because it went up times 10 in value. So while the amount that you can lose can go to zero, you can only lose what you put in, but how much you can make is pretty much indefinite. It's infinity. There's no limit to how much you can make. And the next thing that I would study if you're a beginner, and this is most important, and this goes hand in hand with how I started my strategy. I have a very safe, conservative strategy, and that's why if you're new, even if you have nothing to do with the stock market, you probably recognize a lot of the names that I have on here. Like I'm sure all of you know Starbucks. I'm sure all of you know Cisco. I'm sure all of you know Coca-Cola, McDonald's. A lot of these names are names that you probably know and see every single day. And that is because I looked at what has made other people wealthy in the stock market. And that's owning companies that I know, I understand, and I know will be successful in the long run and have been around for a long, long time. So basically the way I look at it, we'll just take Coca-Cola for example. Okay, Coca-Cola has been around for hundreds of years. Do you drink Coca-Cola products? Do you think other people drink Coca-Cola products? Well, if that's the case, is it not safe to say that Coca-Cola will be around 10 years from now? I think so. If that's the case, if they're still around 10 years from now, then they're probably going to still be raking in billions and billions of dollars worth of profit, worth of pure profit, where you as an investor, where you as a shareholder can take advantage of that. And that is why they increase their dividend payments. Their share price typically goes up over the long run, and that is how me as an investor, that is what will make me wealthy 10, 20, 30 years from now. And that is the same way people like Warren Buffett and lots of others have made a lot of success in the stock market as well. Step number 3, once you've narrowed down all the basics, once you have the basic ideas of how the stock market works, you should choose an online brokerage. Now, there's lots I could recommend, but what I will say is that you should stick with only free online brokerages. If it is not free, if it is charging you commissions, you should not use it. It's not worth it. And only use what you're most comfortable with. In my opinion, it's probably best to get started with a small amount of money with, say, like $100. Open up 2, 3, 4 different accounts. Do some research on like YouTube and some other websites to figure out what's best for you, but only use what you are most comfortable with. Even if that's not M1 Finance, which is what I recommend, even if it's not M1 Finance, you should only use what you're comfortable with. Some of the top most popular names for free brokerages out there include things like M1 Finance, Robinhood, Cash App. I know a lot of accounts like bigger accounts like Fidelity and Charles Schwab offer free accounts now. And so check out all those big names and lots of others as well and see what's best for you. But for me, M1 Finance is my ride or die. I doubt that I'll be leaving M1 Finance anytime soon. They are my recommendation. And like I said, what I mentioned at the beginning of the video, if you decide that you want to sign up for this, this is in the description. This little link right here. We've had 72 people sign up and you'll get $30 just for getting started. But like I said, it's your choice. Only use what you're comfortable with. Only choose free brokerages and find what's best for you. Number 4 is to define your strategy. Okay, so you know the basics of stocks. You have your brokerage picked out, and it's best to define your strategy. If you're just wildly just owning companies, you're probably not going to have a whole lot of success if you don't really know what you're doing. It's usually best to define some type of strategy. So that could be a number of different things. That can include, do you want to own index funds or do you want to own individual stocks? So index funds include things like what I showed you, like with SPY. Do you want to own just one index fund or do you want to own multiple? And with individual stocks, do you want to own all individual stocks like I do? I own 24 different companies. Or do you want to own partial, a little bit of both? Do you want to own some index funds? Do you want to own some ETFs? Do you want to own some individual stocks? It's whatever you choose. You got to define your strategy. And then next you have things to choose as well, like growth investing versus dividend investing. So companies that are a little bit newer to the stock market and still in a little bit of a growth phase, like let's say, for example, let's take one that a lot of people look at, Tesla. Tesla is a company that has went up massively in the last couple of years, and this is because they are a growth stock. So you do not get any capital returned to you as a shareholder. You have to hope and wait for the price to go up in value. Now, usually with these growth companies, that usually happens much faster. And the same thing with other large companies, like the largest company on earth, Apple. Apple is mainly a growth company. That is why its value goes up quicker. But if you have other companies, there's another strategy if you do what I do. Like, for example, let's just take dividend investing. Let's look at Home Depot. We haven't looked at that one yet. This is one that I'm sure a lot of you know and understand. Home Depot has still doubled in price in the last 5 years, but it pays capital to shareholders. Here, it paid 69 cents every single quarter in 2016, and then it went to 89 cents in 2017, $1.03 in 2018, $1.36, $1.50, and now they're due for another dividend raise here in 2021. So it's whatever strategy you choose, but dividend investing versus growth investing is usually the two most popular. And last but not least, I wanted to mention active versus passive. Now, this could mean a number of different things. This is pretty broad, pretty open. But active meaning, do you constantly monitor your investments? Do you change them every month? Do you change them every quarter? Do you change them once every couple of years? And versus passive, it's usually a very set and forget it type of investing. I would say I'm probably somewhere in between these two, because I do change my investments a small amounts. Even the last video I noticed I talked about, I increased my position in Kimberly-Clark. I think it's a good value right now. These are the company that owns all the type of toilet paper and diaper products and things like that. But I think it's at really good value right now. So I increased my position in Kimberly-Clark. So I am kind of in between. I do kind of actively manage my portfolio, but most of what I do is really passive and I don't really manage it a whole lot. But pick what's best for you, define your strategy, and most importantly, stick with it. Do not change it. Number 5, and the last but not least, get started investing. And I'll go ahead and give you some of the main bullet points to avoid here as a new investor. Do not play the short game. And what that means is do not focus on the short term. Do not trade. Invest, do not trade. Trading is, oh, I'm going to buy Kimberly-Clark today, and the stock went up. I'm going to sell today. That is trading. That is, oh, I'm going to buy today, and I'm going to sell next month for a gain. That's trading. Oh, I'm going to buy today, and I'm going to sell next week for a gain. That's trading. If you're investing, I'm buying this company, and I'm selling it almost no matter what. I'm so bullish on these companies, and the example I gave with Pepsi and Coca-Cola, people are always going to need something to drink. And I give you another example. Let's just take Realty Income. This is a real estate company that owns thousands of different properties, including things like AMC Theaters and Walgreens and Walmart and Home Depot and lots of other big names out there. And basically the way I look at it, Are businesses always going to need a place to hold their actual physical property? Yeah. Is that still going to be a thing 10 years from now? Very likely, yes. Well, if that's the case, then realty income is going to be alive and thriving. So, me as a shareholder, that's why I'm investing in it. But no matter what this company does, it could go down to $40 a share tomorrow, or it could go up to 100. I'm investing in this company no matter what. And do not play the short game if you're brand new. This will cause you to lose money. Trust me on this. And this goes hand in hand with step number 1. Avoid risky bets such as options, shorting, penny stocks. Lots of other things like this is what cause beginners to lose money. So don't even research these things. Ignore them completely. This will avoid you losing money in the stock market. Number 3 is to stick with companies you believe in. If you do not believe in a company, if someone just told you a hot tip or you looked online and you read an article but you don't understand something, then don't invest in it. Like, for example, I'll tell you a company that I love, but I don't really truly understand a whole lot. I need to do more research into it. I love NVIDIA stock. From what I've seen about them, they seem like an incredible company. They have some compelling products, and they're a company that I honestly sound like I'd probably be interested in investing in. But I fully don't understand their business model, to be honest. It's something that I just can't wrap my head around, and it's hard for me to understand. I'll give you an example of another one. I did a video recently about AbbVie. I love the company. They have an awesome track record. They're probably a company that would go well with the type of investing I want to do. They're a great dividend growth company, but AbbVie, I don't understand pharmaceuticals that much, so I'm not going to own it. I'm not as confident in owning AbbVie as I am saying owning another healthcare company like, say, Johnson & Johnson. I can wrap my head around Johnson & Johnson, and I know how the company works. So that causes me to not sell it, and that's why even today, wow, I didn't even notice that. Even today, it's at all-time highs. So me as an investor, I'm constantly getting profits, and that's why right now I'm up a little over 30% on a money-weighted return. So anyways, guys, the last but not least that I have for you is to only invest in what you can understand, stick with companies you believe in, avoid the risky bets such as options, shorting, penny stocks, all that type of stuff, and do not play the short game. Only invest, do not trade. And if you do everything with what I said, you can go ahead and get started and probably be very successful in the long run. And these are some of the basics that I could hopefully give you to help get started out. But thank you guys so much for watching. I really appreciate it. Like I said, go ahead and get signed up if you like this brokerage. If you want to get signed up at the end of this video. But thank you guys so much. I invite you to subscribe, and I'll see you next time.